a group, as it were. So when we talk about consolidation of financial statement, we are actually looking at being able to bring all of the accounts of all the entities that are within the group into one presented financial report. So we have what we call the parent in the group, and we have the other one that we known as that is known as the subsidiary, the associate, and then the joint venture. And so the parent is the one that is to prepare a consolidated financial statement, whereas the subsidiary, as it were, is the entity that the parent has control in. When we say control, it means there is what we call a significant control that is above 50% stake or 50% purchase or 50% authority in that particular company. Take, for instance, Oyindamola now buys over 50% of the shareholding of the equity of Thomas PLC. It implies that Oyindamola have over 50% control in Thomas PLC, and that is what we refer to as parent, and then Oyindamola is the parent of Thomas as the subsidiary. And when we say control, it means that you have a higher percentage in the determination of the affairs and how the company should be run. That is that for that. So we have the parent and then the subsidiary. And then we have the associate. Associate simply means that you have less than 50%, but above 20% rather in an entity. And that makes you what we call an associate. So in other words, if you have between what is it called? Between 20% to 49.9999% in an entity, that means you have what we call an associate under you as a parent. It's also an associate under a parent. Please, I'm stating this because this is the beginning of consolidation. If you don't know this, there is no way you can deal with it. That's that for that. And then for the subsidiary, we say is 50% and let's say 50.1% and above. 50.1% and above. That is what gives you the right to become a parent to a subsidiary equals a subsidiary. So the company will be referred to as a subsidiary. Whereas when we have what we call a 50-50 stake, this is what we refer to as a joint venture. A joint venture. So as an entity, you can have all of these in a group. You understand me now? All of these, you can have them in a group. And when they are in a group, you should know that if you are to be registered or if you are to be quoted on the stock exchange, there's a spelling that you must present consolidation. In other words, if you are not to be you are not going to register yourself on the Nigerian Stock Exchange market as an entity operating in Nigeria, you may not consolidate your account. You may allow the other members of the group to prepare their financial statement as well as present it as a standalone entity. You understand me now? You may allow that. You understand? And then you may also wish, because of the members of the public, to consolidate your account because of users, or for investment purposes, you may as well consolidate your account. So the major requirement for consolidation is when you are to subscribe to the stock exchange. That's when you are meant to, by law, consolidate your account. But you can as well choose not to consolidate. That's what the emphasis I'm trying to lay. But let's assume that you are now becoming a professional accountant. You are to consolidate a financial statement. How do you go about it? And that's the essence of this lecture. Apart from you writing the exams in the forthcoming month, you should be able to know how to also consolidate. That's the essence of this lecture. And having said all of these, you should know that that we have been able to look at how to prepare and present financial statement of standalone entities, that is single entities. Is that not so? I'm sure you know how to do that. So if you don't even know how to prepare it, you may not be able to know how to consolidate if they are requesting for your service. And that's the essence of this lecture. So let's proceed to how you should be able to consolidate your financial statements. How to consolidate financial statement? Let's go on. How to consolidate? I told us in the last class there are about 5 major financial statements, like I still mentioned that in this morning. But you can be asked to consolidate the 4 financial statements: that is statement of financial position, statement of profit or loss, another comprehensive income, as well as statement of cash flow and statement of changes in equity. But at your level, I doubt if they will ask you to consolidate these 4 at once. They can only ask you for one. And if they should ask you, see, the simple thing is this: the simple logic into consolidation is they are only asking you to, that's why I say it's very simple. They're only asking you to add A plus B. The one for Oyindamola and the one for Thomas, just add them as one. That's what they are asking you to do. You understand now? So whether it's a set of financial position, set of profit or loss, set of changes in equity, or set of cash flow, all that they are asking you to do is to add the parent plus the subsidiary. But for the subsidiary and the associates and the joint venture, you should know that certain limitations are bounds, and that's why you need to know the step by step and how to go about it. So let's proceed. How do you consolidate financial statements? So this particular afternoon, we are going to begin with statement of financial position. Statement of financial position, that is SOFP. How do you consolidate? And I told you in the last lecture that if you have to consolidate, you only need 2 basic steps. 2 basic steps. The step 1 is that you do what? You open the skeleton, please. Like this is the best way that I can teach you that you will not forget. I'm sure when you get to exam, you won't forget what is a skeleton. Open the skeleton. That is the step 1. Don't forget that. Step 2. Step 2 now. Add body. Somebody will be saying, what am I saying now? I'm telling you, this is only the basic way. Add body to the skeleton. Skeleton. By doing the following 7 workings. 7 workings. For statement of financial position, this is the 2 main steps that you need. Number 1, I said open the skeleton. Number 2, I said add body to the skeleton by doing the following 7 workings. Is that clear? Are we still on the same page? Is it flowing well? Step 1 is
yes,
what?
sir, yes.
What is step 1?
Open the skeleton.
Open the skeleton. Step 2, what do you do?
Add body.
Add the body
Add
to
body to the
the
skeleton
following working.
by doing the following 7 things.
By doing the following 7 workings. That is the 2 main steps that you need to know. So now let's go. How do you open body? Open the body. We have been able to look at this the other time. I told you that once they give you a question, you should know that there will be a parent and a subsidiary and possibly an associate. Once you have these 3 in views, you should know that. Note the following. Okay, let's begin with but I want to do the 3 together because we don't have time. Where you have the parent plus the subsidiary plus the associate. Please listen very, very attentively. Or let me not merge it because of, so I won't bother you. Okay, let's start with parent and subsidiary first. Once you have parent and subsidiary, let's mirror it down to your exam now. In your exam, and they ask you to deal with parent and a subsidiary, no associate for now, or no joint venture arrangement as it stands. What you need to do under the zone of profit or losses, whatsoever is the asset. Please listen. Whatsoever is the asset, whatsoever is the liability, please just add them together. Add and open it down. Open the bracket down. You can add and open the bracket down. I know what I'm saying. Just listen. Be following me this small way. So everything that is under the assets, if parent now have PPE 100, subsidiary have PPE 50, just say 100 plus 50. Open that. You can open bracket in front of PPE now. When you are doing your consolidation, open the bracket down. You just write 100 plus 50. Leave it. Move to the next one. All the assets, you do them. All the liability, you deal with them. But for equity, you are going to make we are going to do some adjustments. Number one, under equity, you are only going to carry only the parents' equity. Carry only what? Parents' equity. Ignore the subsidiaries' equity, because you will make adjustment on it. That is number one, under equity. Number two, ignore the reserves. Ignore the reserves of the two entities. Ignore reserves of the subsidiary. Let's just say that of the subsidiary. Carry only what we call, carry only the group reserve. Until we begin to do question, all of these things will look strange to you. Carry only the group reserve. Ignore the reserve of the subsidiary. This will also bring about workings. So that is that for that. These are the main things that you need to know. Now, let's go to the step 2. So that I know I've dealt with this in the previous video, but for those that are not there, that's why I'm refreshing now, so that you will have some level of understanding. So I said step 1, open the body. Open the body. So the beginning of opening of the body is number 1. You have to write the name. Write the name of the group. This is very, very important. This is where you should start from. If you have Oyindamola PLC, please write it. Oyindamola PLC consolidated statement of financial position for the period ended 31st December. I'm taking it slowly. Sorry, please, for those that just bear with me, because of those that are just joining. 31st December 2025. This is where to begin your opening of the body from. So let me be right name of the group. That is 1. 2. Right the currency and the rounding of figure, and the rounding of figures. Very, very important. So if it is in naira, you write naira. If the rounding of figure is 0, you write 0. If it's in naira and the random figure is in million, please write million. Very, very important. If you're able to do just these two, I can assure you that this half mark, you have already gotten a half mark. And then you are looking for 49.5 to pass. And then the third one is 3, is to combine like items. That's what I was trying to explain with asset and liability. Combine like item. That is asset to asset, and then liability to liability, and like that. Liability to liabilities, liability to liability, and like that. But for equity, please. For equity, there will be adjustment. Only carry the parents ordinary shareholding or share capital, the parent share capital alone. By this, we will have been able to do what we call opening of the skeleton. It's as simple as that. Step 2, I said you will do. Who can remind me what we do in step 2?
We add the body to the skeleton.
Yes,
by doing the following seven.
Yes, thank you so much. Skeleton by doing the following 7 workings. Please take note, 7 minimum workings. You can do more than that, but 7 minimum workings. And always begin with workings 1. Not compulsory, but it is important for you. Workings 1. What is your workings 1? Please note it. The workings 1 is you have to determine the date, determine the years or year in consolidation. How many years exactly are you consolidating? You should know the years. It's very, very important for you to know it, because you will need it when you are doing certain adjustments. Take for instance, Oyindamola PLC acquire Thomas PLC. Oyin acquire Thomas PLC T on 1st January 2024. Let's say 2023. Date of consolidation, which is also known as a reporting date. Date of consolidation is 31st December 2024. How many years do we have here in this consolidation?
1.
Somebody is saying 1.
2 years.
Somebody say 1. Somebody say
2 years.
2 years.
Somebody say 1. Somebody say 2. Just hold on. Let's go on. How do you do it?
2
When
years.
you are to determine the years of consolidation, don't feel that it's a waste of time. All that you need to do is just write date of acquisition and go from date of acquisition, write it down. It's what? 1st of January 2023. Is that also 2023? That's date of acquisition. The date of consolidation or reporting now is what? 31st. See it? 31st of December 2024. 1st of January 2023 to 31st of December 2023 is how many years? 1. 1st of January to 31st of December 2024 is how many years? 2. So by this, you will know that your date of consolidation, how many years? The years in
2 years.
consolidation, the years in consolidation is equals to how many years? 2 years. Very simple. Is that also very clear now? So let's go. That's number 1, workings 1. Workings 2 is you should determine the group structure. Very, very important. You have to write it out. Group structure. You need to tell us the group structure. Now, let's continue with Oyindamola and Thomas. Yes, we were told that Oyindamola acquired Thomas on 1st of January 2023. Is that also? So you need to know exactly the portion of equity that Oyindamola or the parent, as it were, acquire in the subsidiary. You need to know it, and then you also have to tell us. ACQ simply means acquisition, please, for those that is asking, for those that are asking me. So we need Oyindamola need to know to tell us exactly the portion of equity that he has acquired in Thomas. That is what will tell us if Thomas to Oyindamola is a subsidiary or an associate, or they are into a joint venture partnership. We understand that now. I should come again. The group structure tells the group structure tells us the portion of equity that the parent controls in the subsidiary. That's why you have to determine the group structure. So now let's assume that Oyindamola acquire 80%. Oyindamola acquire 80%. Or acquire 80% of equity. In Thomas. So the group structure is now going to be O being the parent, you put it O, you put it here. Then you will now draw an arrow. You put O here. Then you will draw an arrow. Very, very important that you should note this. Draw an arrow. 1 minute. Okay. Then under the arrow, you put T there to tell us that this is what the controls you are having in T. So you are allowed to write it like this, 80%, or you write 80% in bracket here, and then 20%. I know that some of you know this, but for the sake of those that don't know it, that's why let me take it in a layman way like this. Bear with us. You understand me now? And then you let us know that this is NCI. NCI, that is non-controlling interest, is equals to 20%. You can write it like this. Or you just write, you ignore 80% NCI, and then you may write it like this or like this. Is that taken? Thank you. So that is workings 2. Now, acquisition can either be 100%, which is known as wholly. And when you acquire the equity of a subsidiary wholly, there is no need for you to do what we call consolidation. All that you need to do is you just prepare your account as a standard. You just combine everything as one because you have 100% stake in that entity. But if you have less than 100%, you should consolidate. Very, very important. And follow these steps that I have explained. So that's workings 2. Workings 3, is it clear enough? Can we go ahead? Workings 3.
No. Hello, sir. Hello, sir.
Go ahead, please.
Sorry, I just want to get the recap of what you just said now. Supposing if a company is having the 100% only in the of the subsidiary, meaning that we are not, I didn't get what you said very correctly. Are you saying that we should just consolidate everything or what? I just want you to recap that stuff.
Yeah, that's what I just said now. Now, if the company is only, that's 100% acquisition. Do you understand me now? It means that that entity cannot operate as a standalone. You are going to combine every of your resources as one. Do you get it now?
Okay, sir.
Yes, you are combining resources as one. So there is no need for you to
the
determine the group structure, all of those workings, goodwill, maintenance.
okay.
You won't determine fair value because there is nothing to determine there. So that's why I said there is no need for doing a consolidation. You combine everything. Instead of consolidation, you'll be doing what we call combination.
But sir, the word of that combination is what I'm trying to get now. By combining everything together, is it not the same thing as consolidation? I've said that we are not considering the NCI or goodwill.
You know that in the process of consolidation, for instance, we have what is it for now? You have what we call you are going to determine the NCI, right? You are going to determine goodwill.
Yes.
You are going to determine fair value of the net asset. You understand all of those ones, because that is the core of consolidation. That is the main thing you do in consolidation.
Okay. But that combination that we want to do now, what are we going to call it? Are we going to exclude the word of consolidation from it? I mean, for the 100%. I mean, the heading.
The first thing first is you can't even recognize the entity as a group entity.
Good.
Do you understand?
Good.
Because you have already acquired 100% in it. That cannot be your subsidiary. It may be your subsidiary, but you have to combine because you have 100%. 100% means 100%. It's just like, take for instance, when UBA acquires Standard Trust Bank.
Okay.
You understand? Or when Access Bank acquire, which one did they acquire of recent now? Diamond Bank. Are you seeing Diamond Bank now? There's no Diamond Bank again. You understand me now? But assuming that Access Bank acquire, let's assume, less than 100% in what is it called? Diamond Bank. Diamond Bank will still be existing as a subsidiary of Access Bank.
Okay.
Do you understand me now? So that's why I say all of the assets and liability and equity will be combined. So there will be no for consolidation.
Okay. Thank you, sir.
All right. So working study, I said determine. The working study will be what? Determination. Okay, go ahead, please.
Yes, sir.
Go ahead, please. Oh.
All right, sir. Good afternoon. Sorry to take us back again. Sorry. I understood the working two, but I don't understand the working one very well. Could you please explain more, please?
Okay.
Thank you, sir.
Workings one, please mute your mic. Workings one talks about you determining the years in consolidation. That is the number of years you are even going to consider when you are doing consolidation. And I said the first thing first that you will do is to know the date of acquisition. The date of acquisition means the first date that parent acquire certain portion of equity in the subsidiary. You need to know that date. And then the second date that you need to know is the date that you are reporting or the date that you are consolidating. You understand now? So once you know those dates, it will give you an overview of the numbers of years in consolidation. And I said in you doing this, let's assume that Thomas or Yindamola acquired Thomas on 1st of January 2023. And date of consolidation is at the 1st of December 2024. How do you determine the years in consolidation? The first I said, put down the date of acquisition, which is 1st of January 2023, and then put down the date of consolidation or reporting, which is 31st of December 2024. Now you will need this date usually when you are doing some adjustment. For instance, in depreciation, For instance, in intra-group transactions, you will need it. Please take note of that. Now, date of acquisition is 1st of January 2023, and the date of consolidation 31st December 2024. 1st of January 2023 to 31st of December 2023 is 1 year. 1st of January 2024 to 31st of December 2024 is another 1 year. 1 plus 1 is 2. Therefore, the years in consolidation is 2 years. I'm sure it's clear now.
Thank you very much, sir.
All right. Working theory is a determination of the net asset of a subsidiary. Usually at acquisition date. Very, very important. You have to determine it at acquisition date, reporting or consolidation date, and then you have what we call post consolidation date. You are allowed to write what I've just written now at acquisition date, consolidation date, and post consolidation date. Very, very important. Well, you can as well do it this way, but make sure you write what I call. Always write the currency under. For this, at acquisition, you write it there. Very, very important that you have to write it to. Very, very important. At consolidation date, and then at post consolidation date, you have to write it. Now, what do we mean by the net assets? We are talking about all of the items that are under the equity of the subsidiary at the reporting date. You have to note it. You need to know what is obtainable at the date of acquisition, as well as the date of reporting. Now, every items that you see in your question, that you see that is being that you see your question that is not in story, that is in theories. All of those items that they are not in theories. I'm just giving you a clue now. All the items that are not in theories, they usually form part of that's where you will get usually information that you will need for the acquisition date. Let me take it again. All of the information that are theoretical, all those stories that they will tell you, that is usually where you will get information for the acquisition date. Out of the consolidation date or reporting date, that is the one you will see as draft. They will tell you the draft or the financial statement of this person as at 31st of December. So is this. And again, let me also state this. They may not tell you the date of the reporting date or the consolidation date. Well, how will you know the date of consolidation or the date of that you are reporting? It is, you will see, usually you will see it in your required prepare consolidation statement of financial position for the year ended 31st December 2024. That's your reporting date. Is it clear enough? I'm sure it is clear. Workings 4. Are we still together, please? Thank you.
Yes, sir.
Workings 4, I said, workings 4 is determination of goodwill. Determination of goodwill. Very, very important. Now, what is goodwill? Goodwill simply means, this is highly expanded under IFRS 3, business combination. Goodwill simply means the gain that you make. Let me put it in layman way. The gain that you make when you acquire a subsidiary. The gain that you make when you acquire a subsidiary. In other words, how do you determine it? When the amount that you pay is higher than the net asset of the subsidiary at the date of acquisition. If it is higher, what you are going to get is a loss. And that loss is what we refer to as a bargain on purchase consideration. Let me take it one after the other. Because I know some of you now, you don't understand what I'm saying. There is a price that you pay to acquire a company. That price that you pay is known as a purchase consideration, the amount that you pay. Now, also, understand that purchase consideration can come in 3 ways. That is, when we say purchase consideration, in a layman way, the amount that parent used to acquire a portion of equity in a subsidiary or associate or in a joint venture arrangement, the amount that parent pay. That's what we call purchase consideration. Is it clear? I'm sure it is clear. Now, that purchase consideration can come in 3 ways. It is either the parent can either pay in cash. In cash, please take note of that. Or pay using share-to-share exchange. That is, you exchange your share, parents exchange their share for the subsidiary share. And the third one is known as a deferred or contingent consideration. This means that the parent now acquire a portion of the equity of the subsidiary, but the payment will be made at a future later date. That's why we call it deferred. The payment will be deferred to a future later date. Take for instance, Oyindamola now acquire Thomas 1st of January 2023. You understand? And then the percentage of the equity that Oyindamola acquire is 80%, but he did not make payment as of 1st of January 2023. He said, okay, I want to see how this thing will turn out, but we agree that you own the 80% of the equity. So I'm going to make payment on on 3rd of December 2024 is agreed. So the payment will be deferred up to that point in time. You understand now? Then there is another one that is also known as a contingent consideration. This contingent means that, take for instance, you are borrowing a loan. You may say you are borrowing a loan, and that loan, until I pay back the loan before I pay you and the like. So all of those arrangements can come. But all you need to know is number one, you have cash consideration, share for share, and then deferred or contingent consideration. And please note this, that whenever there is a deferred or contingent consideration, you will always do what we call, present value evaluation. In other words, you are going to determine the present value of the future payment that will be made as at today. What will be the present value of that amount that you have to pay in a foreseeable future? You have to determine it. So that is that for that. So in determination of goodwill, let's go back to goodwill. The format is very, very simple. It's not something that is difficult. But you need to understand that the first thing first is purchase consideration. That's why I took my time to explain it. Purchase consideration first. That's I'm giving you the format now. Purchase consideration. That's the first one. Then there is what we call increase in fair value of recognized in other reserves. That is, there is what we call other reserve, but ignore it. Let me not bother. When we get to the professional level, that's when you begin to see that one. That one you will not see it at your level now. You will not see it at your level. Just take note. So purchase consideration, that's the first thing you should know. Now also, goodwill can be determined using 2 methods. The first method is what we call the full or fair value method. And the second one is what we call the proportionate method. The full or fair value method simply means that you are determining the goodwill by considering the fair value of the non-controlling interest at acquisition date. That's why you have to do this working study. That is, what is exactly the fair value of NCI, the non-controlling interest, at the date of acquisition? When we say non-controlling interest, it means that the one you don't have control over. I hope I'm making sense. If I'm not making sense, just let me know so I will go back.
Sorry, come again, sir.
When we say there are two methods of determining goodwill, we have the full or fair value method, and we have what we call the proportionate method. Under the fair value or the full goodwill method, you are going to carry or recognize the fair value of what we call the non-controlling interest at acquisition dates. You see, if you go back to this working study, we have what we call determination of net asset of subsidiary. This subsidiary is also known as NCI. NCI. Is that taken? Net asset of the subsidiary or NCI at acquisition dates. Do you get it now? So instead of only recognizing the portion of the what is it called, the parent now, you are going to only use the portion of the NCI. That's when you are using the full goodwill method to determine goodwill. The full or the fair value method. And if you are now using the proportionate, when we are doing calculations, you understand better. When you are using the proportionate method, it means that instead of you considering the portion of the NCI, you are going to consider the portion of the parents. So that's the difference between the two. For full goodwill, you are considering the fair value of the net asset of the subsidiary. But for proportionate, you are considering the parent proportion of the net asset at acquisition. Let me come again now so that you will understand it from here. Let us put figure under the working study. Let's assume that this acquisition date here, we have 100 total, net asset as 1,000 or less 100. Please follow me. And then consolidation is let's say 120. The post consolidation will now be how much? 20. So usually this is what I will always advise students to do. When you are in your exam hall, please put on this acquisition date A, consolidation date put B. Then on this post consolidation date, put C. C equals to B minus A, please. With this, they know that you know what you are doing. Is it clear enough? Can I go ahead?
Yes, sir. Yes.
Yes, sir.
So we have a put figure now. Now, determination of goodwill, I said we can use two methods. Either two methods can be used. We have the full. This full is also known as a fair value method, or the proportionate method. Proportionate method. Do you understand now? Thank you. So now let's start with full goodwill. Full goodwill. Under this full goodwill, whether you are using full or proportionate, the first item that comes when you are determining your goodwill is a purchase consideration. Let me write it in full because of some people. Purchase consideration. That is the first thing first. Please take note of that. Now, let us assume a question now, please. Let's assume a question. Thomas Oyindamola acquire Thomas 80% equity on 1st January 2023 for 200, let's say assume it 200,000 naira. You understand me now? You have to determine now. This 80% is that's what you use. This 80% to determine the group structure working stew, and the purchase consideration will now be 200,000. Please take note of that. So the purchase consideration now under this question is 200,000. Now let's have a full frame question for 200,000. When the NCI, when the fair value of the NCI is 100. Do you understand me now? This is what we call fair value of the NCI. The required, okay, before we say required, the net asset, I want to bring out something. At acquisition date is 120. Let's say 80, sorry. It's 80 kobo. 80,000, sorry. Please take note. Determine goodwill using the two methods. Using the two methods. Who can tell me what are the two methods?
Full fair value and proportionate.
Full or fair value, please. Full or fair value, not full fair value. Full or fair value, okay. And the proportionate. Thank you. So determination of the goodwill. So now let's use the full goodwill. Now let me also state this. We were told that the NCI, where is the question? On the acquisition date, they say the net asset at acquisition date is 80K. Is that not so? But we're told that the fair value of the net asset of the net asset of the subsidiary is 100K. In other words, the day that let me Thomas, that date is mute your mic. Mute your mic. The net asset at acquisition date is 80,000. But on that same date, the fair value of the net asset is 100,000. So now, according to business combination IFRS 3, the fair value is what you will use and not the net asset at acquisition date. Let me come again. If at the date that I am going there to acquire, the day that Oyindamola is acquiring Thomas, his net asset that he presented to me was 80,000. But I now call some persons, so let me check the fair value of the asset. We were now told that the net asset, the fair value of the net asset has increased from 80K, 100K. According to IFRS 3, you are going to carry the 100,000 and you will leave out the net asset that you determine. The net asset that was determined working theory, you are going to ignore it. You are going to use the one in the question. So usually, why am I saying this? Usually, the fair value of a net asset usually used to be in the question. They will tell you. But if they are silent, you should know that you cannot use the fair value or the full goodwill method. If they are silent, if they are silent. But if they ask you to now use the full goodwill method and they did not give you the fair value of the NCI at acquisition date, please use the net asset that you determine in Work 3, the full of it, as your what is it called? As your full fair value that you will carry and out of the purchase consideration. So let's go ahead. We are determining using the fair value. So that's why this method is called full or fair value. If they give you the fair value, please just carry it. Forget about the net asset at acquisition date. You understand? But if they did not give you the fair value and they ask you to use the full goodwill method, please carry the net asset. What I'm saying is this. Now, in this question, we were told that Oyindamala acquired 10% for 200K when the fair value of the NCI is 100K and the net asset at acquisition date is 80. If we go back to our working study, it means that the net asset at acquisition date is 80. You understand now? But let's say let's assume that the consideration is we don't need this. What we need is the 80. Now let us assume that in your question they did not give you this fair value. Let's assume they now say the net asset at acquisition date is 80K. Determine goodwill using full method. Since they did not give you the fair value of the NCI at acquisition date, but you have done the workings, or they give you the net asset at acquisition date to be 80 as it were, you are going to use the 80. Is it clear? But let's assume that they now give you this fair value of the NCI to be 100,000 at that acquisition date. Ignore the 80, carry this 100. That's why I say it is either fair value or full. So the full means 80 total, the total at acquisition date. I'm sure you understand it. So let's go ahead. How do we determine it? Purchase consideration is 200, and then we were now told that the what is it called now? The fair value of NCI is 100. So you had this fair value of NCI, we are told is 100. Add it to it, and then you less net asset of subsidiary at acquisition date. Of subsidiary at acquisition date. Very, very important. And then we were told that then the net asset acquisition date is 80. When you less this, you are going to now have the goodwill, which will now be 220. It's as simple as this. So if we are using the proportionate method, under the proportionate method, the purchase consideration will still be 200. Purchase consideration will still be 200. But what you are going to add under the proportionate method is the parent portion of the net asset at acquisition. I mean, what you are going to less rather. Remember, under the full goodwill, what we less is the net asset of the subsidiary at acquisition date. Is that not so? But under the proportionate method, we are going to less parent portion. Remember, it's 80%. So parent portion is what we are going to less. Parent portion at acquisition date. When we do question now, you will understand all of this, which is now going to be 80% multiplied by the net asset we were told is 80, multiplied by 80, How much do we have there? Somebody should help me do 80% of 80 is what?
64.
64.
64. 64.
Okay. So this is what you are going to now less. So when you less it, whatever you have becomes your goodwill. However, take note that once there is an impairment,
Sorry, sir. You haven't considered the NCI.
The NCI. This is parent portion of NCI at acquisition date of NCI at acquisition date. 80% of 80. Is that not what we have? Look at the question. The net asset at acquisition date is 80. Do you understand it now?
What I mean is that when we are under the proportionate, as we are considering the we've calculated for the parents and we haven't calculated for the NCI. That's what I mean.
You don't need the NCI again. Well, but maybe I don't understand your question, but you don't need the NCI again. Do you understand what I'm saying?
No, sir. I just want to get it clear, sir. You know that we are trying to consider the goodwill now. I know that under this full or fair value, this is what we've done. Then under this proportionate method now, you know that we've already gotten the parent, what's it called? The parent portion of the net fair value of the net asset, which is 64. Are you saying that in this aspect, under the proportionate, we are not going to consider we are just going to deduct what we have from the parent consideration to get the goodwill? I just want to get it clearly. I think you understand. I don't know if you understand my question.
Yes. No,
under this proportionate, let me come again, sir.
Let me go back again and let me explain it in a more simpler way. You see, for the full goodwill method, for the full goodwill method, there will always be what we call fair value of NCI at acquisition date. In other words, the net asset of the subsidiary at acquisition date, there will be what we call a fair value on it. When we say there is a fair value, it means that, for instance, this question that we are looking at now, it means we were told that in the acquisition date, what we have as a net asset of a subsidiary acquisition date is 80. But we're told that when the fair value of the NCI is now 100, it means that if we are going to consider everything together, it means that the net asset of the subsidiary at that date should be 180. But you see, what will bring about, according to if you read the IFRS 3 very well, what will bring about this fair value increment might likely be that because the parent is acquiring a portion of the equity in the subsidiary. Take for instance now, if NextGen, as it were now, NextGen that you all know now, if Dangote should come and say, I want to buy NextGen, I want to buy a portion of equity in NextGen. Do you understand now? There is no way our asset, let's assume it comes in today, there is no way our asset as of today will be at the same portion. What am I saying? The value of our asset will increase. Why? Because Dangote is the one that is coming to buy a portion of our equity. So what we are now saying is this: when you are determining goodwill, you have to also consider that fair value increase. That fair value increase, that portion that increase the value of our asset, you have to add it to the purchase consideration. Then whatever it is, you will now less the subsidiaries net asset at acquisition date. Do you understand now? See, what you just need to know is this. Let me just break it down in a very simple way. What you need to do for you not to get confused is this. When you are determining goodwill under the full method, you have purchase consideration and the fair value of NCI. Those two things, first, you must know them. You must identify them in your question. Add the two together. Then you have what we call the net purchase consideration before you less other items. You understand me now? Now, Whether you are using full goodwill or proportionate, you are always going to less the net asset of the subsidiary. But which one will you less for full and which one will you less for subsidiary? That is where the question is. Now, for full goodwill or for fair value goodwill, the one you are going to less is the total of the net asset of the subsidiary at acquisition date. For full goodwill method, you are going to less everything. But for proportionate, you're only going to less the portion that the parent own. The portion that the parent own is what you are going to less. So in other words, summarily, what I'm saying is this: when you are determining goodwill, either of the two methods, the way the items are to need is purchase consideration minus net asset of NCI. You understand me now? Either of the method minus net asset of the NCI. Sorry. Okay, and this is correct. You minus net asset of the NCI. This is how to determine goodwill any day, anytime. But if you were not told to use the full goodwill, under the full goodwill now, it will be purchase consideration minus the total of net asset of NCI. Please take note, the total. But if you were to be proportionate will be equal to purchase consideration minus parents portion in the net assets. Parent portion in the net asset. That is the only thing you are going to consider. You understand me now? I'm only buttressing, explaining under the full goodwill method why you will always need to add a fair goodwill to the purchase consideration. Whenever you see that there is a fair value of the NCI at date of acquisition, whatever that amount is, and you will always see it in the body of the question. Those stories that they used to write at the beginning or at additional information, you will always see it there. So wherever you see it, always add it to the purchase consideration before you less the net asset of the NCI. Is it clear enough? Are we still together?
Yes, sir.
Yes, sir. Yes, sir. Yes, sir.
All right. Maureen, you raise your hand. I'm sure you are clearer now. So that is what is three.
That was the first question I asked you.
Okay, thank you. So
Thank
now
you, sir.
there's another thing that you need to know. The one we did now, we have where is that one? We have 220. This is a positive, right? Meaning that the purchase consideration is higher than the net asset of the subsidiary. Then it will arrive at what we call goodwill. Now, when we have what we call negative, let's assume now this one is 280. The net asset of the subsidiary is 280, and we have, okay, hold on, it's 380. And we have our net consideration before we remove the NCI at acquisition date. And then we are now having, what is it now? 80, negative 80. This negative 80 is what we know as a bargain purchase consideration. In other words, negative
bargain purchase gain.
Yes, negative goodwill. That's what we call bargain on purchase consideration. So usually this arises when you have what we call the net asset of the subsidiary higher than the purchase consideration. So when this happens, it means that there is a negative goodwill. And once you have this negative goodwill, you have to go and treat it in your, what is it called? Your statement of profit or loss. You have to recognize it there. Also, before we move from this goodwill, you should know that there will always be impairment. And when there is any impairment, you have to less it. You have to less it before you determine what we call the carrying goodwill. What we have here, it will be a carrying goodwill if there is no impairment. Well, assuming there is an impairment, let's say impairment of 20, you have to add it here. And whatever you now have, we'll call it carrying goodwill. And then that's that for that. Any question? I'm sure there is no question. Workings, which workings now? Workings 5, right? Workings 5, determination of the group structure. I mean, the group retained earning, determination of group. We have a question that we have to still look at today of group retained earning. That's Workings 5. Workings 6 is determination of NCI. Determination of NCI. Of course, we don't have time again. Let's quickly look at determination of NCI. And then Working 7 will be determination or adjustment, let's say, adjustment, let's just say adjustments, which can be intra-group, depreciation, etc. In other words, this Working 7 are other adjustments that we just need to make. Any questions? No question. Let's look at this question because we have to finish it today. That DPLC is a first-tier entity quoted on Nigeria Stock Exchange. Remember, I told you that usually it is those that are quoted that do consolidation, but you are free to also do consolidation whether you are quoted or not as an entity, or if your creditor or lenders or investor requires that you must consolidate, you can consolidate. The entity acquired 640 billion equity share in Mommy PLC on January 1st, 2020. The purchase consideration comprised the following. Please, I'm coming. Let me bold this question for the sake of those whose their screen is very wonderful, like my own. So let's go ahead, please. Sorry. So that is that DPLC acquire a first entity quoted in Nigeria Stock Exchange. The entity acquired 640 billion equity shares in Mommy PLC. Please take note, Mommy PLC on 1st of January 2020. The purchase consideration comprises the following. Please, before I go forward, I have always told you, once you see your question, the first thing that you should do is the first part that you should go and read is what? Are we still together?
Requirement.
Go to
Requirement.
required. That's the first place you should go to. Don't read the body, go to required. Now, they said the purchase consideration comprises the following. 1, issue of 1 ordinary share of Daddy PLC investing for 2 shares in Mommy PLC. 2, issue of 100 naira 12% loan notes in Daddy PLC in exchange for 400 shares in Mommy PLC. 3, a cash payment of 15 kobo per share for every share acquired in Mommy PLC. At the date of acquisition, the market price of Daddy PLC shares was 75 kobo. The cost incurred by banks when a fixed rate loan is paid out early is assumed to be 0. Also, Daddy PLC recorded the 12% loan note in the purchase consideration in the accounts. The statement of financial position for the two companies as at 31st of December 2020 are presented below. Now, who can tell me the date of acquisition from what we have read so far?
January 1st, 2020.
Thank you so much. January 1st, 2020. Then the date of consolidation is what? I say always go to where? Go to required.
Requirements.
Prepare consolidation of financial position as of 31st of December 2020. So, how many years is that?
1 year.
1 year.
That's 1 year. So that's that for that. Thank you so much. So let's go ahead. We're now told that the date of acquisition. Okay, we have read this. These are the assets and liability. Sorry, these things are scattered because I increased the font and I also bolded it. I think that's why it's scattered like this. So manage with me. So that is that for that. For those that are snapping the question, please do quick. This is the assets. And then you have the total asset. Then you have the equity and liabilities. Then you have the non-current liabilities. And then we have the additional information. Additional information 1. As at the date of acquisition, the current amount of the net asset of Momi PLC was equal to their fair value, except for an item of property and equipment, which had a fair value increase in excess of the current amount of 50 billion. So take note of that. With additional depreciation of 5 billion in the post-acquisition period, 31st of March 2020. Please take note of that also. This has not been reflected in Momi PLC statement of financial position. The intangible asset was for a television program of Momi PLC as a result of new government legislation on security matter and banditry and criminality. Such television programs have now been pronounced illegal in the country. The appropriate government agency advised the company to immediately stop the television program. Now, let me ask you this question. Intangible asset is treated under which of the standards?
IAS 38.
Thank you so much. IAS 38, intangible assets. So that is that for that. Television program, 12 billion compensation is to be received from the television authority. As a result of the new legislation, the government board of Daddy PLC was of the opinion that goodwill on consolidation has been severely impaired by 30 billion. Please take note of 30 billion impairment. Goodwill. So when you are doing your goodwill, you have to take note of 30 billion. Then number 3, it is group policy to value non-controlling interest at full fair value. In other words, you have to determine, please, once you see it, what will tell you the method to use to determine goodwill is always when they say the group policy is to value. Once they say to value non-controlling using the full fair value. The full fair value is full or fair value. I don't know who put this question here. Full value method. If they put full, just know that you are using full. They can as well tell you to use proportional, but here they are saying use full value. The fair value, I told you, you always see it there. The fair value of the non-controlling interest at the date of acquisition was 100. Meaning that this 100 now will be added to what? The purchase consideration when you are determining your goodwill. Take note of that. Number 4, Momi PLC sold goods worth 20 billion to Daddy PLC during the post-acquisition period. This is what we call intra-group transactions. Intra-group transaction. Please take note of that. And then they said during the post-acquisition period, 5 billion of these goods were included in the inventory of Daddy PLC. Momi PLC made a profit of 8 billion on the sales. So meaning there will be some unrealized profit here now. Please take note of that. Then 5, Momi PLC trade payable is 9 billion. Momi's PLC trade payable of 9 did not agree with Daddy's PLC trade receivable as a result of cash in transit. Please, once you see all this kind of intra-group transaction, always take notes. They have to be, whenever you are saying that receivable did not align with payable, all that you need in that information is the cash in transit. The other ones, just ignore it. In other words, this 9 billion payable. You are going to less it from the trade payables as well as the receivable. The only one that they are going to recognize is the 5 billion, and you are going to recognize that cash in transit, and you are going to add it to bank, bank cash at bank. That's what you are going, where you are going to add it to. You are required. They did not ask me. It is you they are asking. You are required to prepare a consolidated set of financial position as of 31st December 2020. 2020. So the solution. Let's really run through the solution. I said, whenever you see this type of question, what is the step one?
Open the skeleton.
Open the skeleton. Oh, yeah, everybody on your book. On your book, open the skeleton. Open skeleton. Open skeleton. Sharp, 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 sharp. It should not take you more than 1 second. Open the skeleton. Consolidated statement of financial position for the year ended 31st December. Are we done? 2020. If your own is not looking like my own, yeah, it means you are not like me. Currency is in naira of billions, is in billions. So whatever they give to you, that's what you should always bring to bear. So we have done our headings, and I told you the first, just go straight to the body. Go and check the asset. Add all the asset together first. That's how to do it. PPE. Open bracket. Oh yeah. What is under parent? Are we still together?
Yeah.
Oh yeah. PPE. I said step 1, you write the name. Step 2, write the rounding off figure and the currency. Step 3, combine like items. So that is how to open skeleton. Sharp. PPE, what do we have? Under parent.
650.
1.30.
Please snap this and let's go ahead. 650.
650.
Yes. Before we go ahead. Thank you. Before we go ahead, when you are doing your consolidation of financial statements or financial position, ignore investment in your consolidation of financial position. I said it the last time. Investment should never appear anywhere under when you are doing your consolidation. Please take note of that. Thank you. So let's go ahead. Sir?
Would that be a purchase consideration?
That will not be. Let's go ahead. It may not be, but let's keep going. So what do we have under PPE? Parent.
650
Plus
650 plus 350.
350. You leave the bracket open. You go to the next one. What do we have? Intangible asset. I said you ignore what?
Asset.
Ignore the
Investment.
Intangible assets. What do we have?
Okay.
40.
Open it down. That's that for under. So what do we have under current asset?
Inventory.
Inventory. Thank you. So what do we have?
100 plus 25.
100 plus 25. Okay, which other one?
Trade receivable.
Trade receivable. That's still up. Oh, yeah. What do we have?
190 plus 70.
190 plus
190 plus 70. Oh, yeah. Which other one?
bank.
You have back.
So you have bank. Bank is how much?
35.
35 for parent.
Yes, sir.
0 for
Subsidiary.
parent. 35 for parent.
You said?
35
It's
for
0
subsidiary.
for parent. 0 for parent. It's like for subsidiary.
Okay, you leave it. Which other one?
It's finished. Current assets finished.
Then you try total assets. You open it down. You go. So we have equity and liability. Oh yeah. Your equity, I told you, the equity portion, just recognize what? The parent's equity alone. What is parent's equity? Huh?
350.
What's parent's equity?
350.
350. That's the only one
350, sir.
you recognize it. Then the next thing you will write is a group
Return.
reserve. All those other items under equity, you leave them. Do you understand? The next thing you write is group reserve. And if you follow the workings that we have, you know that your group reserve is workings 6, right? Or workings 5? Workings 5. You can put it there. Workings 5, because you know that you are going back to. If you are certain of your work, you just leave it. Just open the bracket, write workings. If you know it, you come and put the number. Then the next thing is recognize the NCI. Then you move liability. What do we have under liability?
12% loan note.
So we have
12%
loan notes.
Trade
Loan notes. Please always start with non-current liability. How much is the loan note? Parent.
150, 40.
150.
Parent, 150.
Plus,
60.
you said?
160.
160.
40.
Any other long-term liability?
No.
No.
Then you have current liability. What do you have first? Payable, right?
Yes, sir.
Okay, go ahead. Payables, parent
150 plus
150.
plus
60.
60.
60.
what other things do we have?
Trade payable.
That's payable. That
Other expenses.
other receivables or other payables.
accrued expenses.
Other accrued expenses.
Other accrued expenses. Okay, what do we have there? We have
40 and 20.
40, 20.
okay. Which other one?
Current taxation.
Current
Taxation.
parent is what?
50.
Subsidiary.
30.
30.
What other thing again?
Bank.
Overdraft. Overdraft, right?
Yes.
How
Yes,
much?
yes, sir.
30.
What of our subsidiary?
None.
Zero. New.
Thank you. So which other one again?
I
Finished.
think that's all. Total
Total
liability.
total equity and liability. Did you see that group account is very simple? This is all the executive to do, just to hard. Eh? So now let me say this. If in your exam, this is all you know how to do, and you cannot do any other thing, just balance. Just all these figures that you have written, loan notes, current, all these people, add them and go and put them at the top, and they will think that there's no time. And if you cannot add it up, leave it this way. The examiner will know that there is no time, and that's why you could not finish up. It's as simple as that. But with this that you have done, this one that we have done, I can assure you that since this mark is 20 marks, there is no way you won't get up to 8 marks in this thing that we have done. Between 5 to 8 marks is certain with this one that we have done. Huh? So that's why I say you should learn how to always do or open the skeleton. So let's go. There's no time. Step 2 is how to open skeleton. No. Step 2, add body to the skeleton by doing the following workings. Workings 1. What is the date of acquisition?
First January 2020.
Some of you are even eating. Date of consolidation. Okay, one by November. What date is that one? November
31
18th.
December 2020.
By November
31st December
18th.
2020.
I say by November 18th, we shall see what will be happening. Me, I will be eating. Let's see what we will be doing. JB?
We'll be happy in the hall.
I'm working. Some of you are eating. Okay.
Sir, by November 18th, we'll be happy, feeling happy in the exam hall.
Okay. Determination.
You'll be happy for us.
You'll be praying for us that we should make you proud.
I'm sure you will make me proud. There's no way you will have attended this class that we will go there and you will not get more than 15 marks. About determination of years in consolidation. Okay, consolidation. So, what is the year now? The years in consolidation is 1 year. Workings 2. Yes. Determination. Workings 2 is what? Determination of the group structure. Please mute your mic, please. Who is that one now?
Olabanji, man. Okay.
Determination of the group structure. But we were told that what is it called now? The parents. Now let's go back. Did they tell us what the group is? No, they did not tell us. They only told us that the daddy acquire 640 equity shares in Mommy PLC, 640. In other words, for us to be able to determine the exact structure, we have to first of all determine the total number of equities that is in Mommy's PLC. Is that also? So let's go. Let's check. Okay. We have here ordinary share of 20 kobo each. Parents have 350. Daddy have 350, mommy have 200. So let's determine the total number of shares that mommy has. Remember, we want to determine the group structure. But first, let's determine the shares in mommy. And we were told that mommy shares is 0 naira 25 kobo per share. Is that not so? And we were told that the value is 200 billion. Therefore, the total number of share of mommy PSC will be equals to 200 divided by 0.25, and that will be equals to what? Huh? 800. So please, it's 800 billion shares. So therefore, we were told that Daddy PSC acquired 640 billion shares of but Daddy PSC acquire 640 billion shares of money. Therefore, the percentage acquired will be equals to 640 divided by 800. That is equal to what?
80%.
80%. So that is the group structure. That's what you need to determine the group structure. So you have Daddy here, and then you have Daddy, mommy, 80%. So you can see that working 2 is also very simple. Daddy, 80%. Mommy is what? NCI, non-controlling interest. Please take note of that. NCI equals to 20%. You need to state it the way I've stated it. Meaning that Daddy don't have control of 20% in mommy. So that's that for that. Any question? Working steady. Are we still together?
Yes, sir.
Yes, sir.
Is it clear enough?
Yes, sir. Yes, sir.
Very clear, sir.
Thank you. So workings 3. Who can tell me?
Fair value of net assets.
Determination of fair value of net assets at
Acquisition date.
Acquisition dates. Reporting. I'm going to use reporting because some people too, they are used to reporting. So reporting and consolidation is the same thing. Reporting date and then post reporting date. So are we still together? I'm sure we are. Post reporting
Yes, sir.
date. Okay. So now, okay, it's very, very important. If you do not put this, we will assume that the question you are solving is not for us. So always make sure you put it. The currency and the rounding of figure. Very, very important.
Sir, in exam, hello, sir, sir. Sorry, sir. Sir, in exam, the shorting of this acquisition, is it allowed in exam? Or
Don't
should we write
short
it in
it,
full? Okay.
don't write
thank you.
anything. This SEQ now, we think is association of community quantity surveyors. Do you understand? Always write in full. I'm begging you. Don't short.
Thank you.
Don't shorten it in exam, please. So now, once you get a group working study, just go directly to equity side of your question, and then look at all the items that are under the equity there. You have the ordinary, return any, meaning there. You can see it there. I hope you are seeing it right.
Yes, sir.
Yes, sir.
Yes, sir.
Thank you. And now look at what they did here in this question. They said retain any at on first, retain any at the closing.
January 1st,
You can see it right. So let's go. So now, what do we have as the first item there?
Ordinary shares.
Sure.
Okay. So we have ordinary share. So the date of acquisition is the same thing as the date of reporting. So what do we have under ordinary share?
350.
No, you are only looking at a subsidiary now. Determination of
Oh, okay.
200.
It's 200.
net asset. Let me put it now. Net asset of subsidiary. Maybe so. How are they putting it now? Of
I didn't see the heading.
subsidiary.
I thought it is for parents. Okay.
Is only the thing we are dealing with now is only subsidiary. So ordinary share at acquisition is what? It says 200. It will remain the same for reporting date, because it is so that your share capital at the beginning of your business is going to remain the same, except if there are issues. That means new issue, as it were. So post consolidation date, you don't have anything here. So you are going to have dash or 0. Simple as A, B, C. What is the next item there?
Retain earnings.
Retain.
Sorry, sir. I have a question, sir. Can I go ahead?
Please go ahead.
Okay, thank you, sir. What you said something now. You said the total shares acquired by the parents in the subsidiary would always remain the same, and if it does not, the only situation that can warrant it to change is when there is a right issue, or let me say there's another issue. So in case there's another issue, how are we going to treat it, sir? Will the post acquisition at the place you asked us to put dash, is it going to affect the place you asked us to put dash? That's my question, sir.
Okay. Well, in my years of teaching and in my years of exposure, there have been no additional issues. You understand me now? But just in the case it happens like that, you should know that you are going to treat it just like you have explained. You are going to recognize it as at the reporting date, as well as the post-reporting date. It will affect your working study. It will also affect your changes in equity. Please take note of that. But I've never seen it happen before. That's why I can say confidently that your share capital as the date of acquisition will remain the same as the date of consolidation. But in the event that it happens, anything can happen. just take note of what I've just explained. Thank you very much for that question. So what is our retained earning?
120.
170.
120.
On the date of acquisition is what?
120 on the date of acquisition.
On the date of reporting is what?
50.
50.
No.
The reporting date?
50. On the reporting date is 50.
50.
Reporting date 50. Sorry, I think that there was a mistake there. It should be 150, not 50. Yeah, please correct it. So it should be 150, not 50. Then post consolidation day is what?
30.
30.
30.
Thank you. Any other item?
None, except if there's any additional information.
So now let's go to the additional information. Additional information 1. Where are you? There's no time. The carrying amount of the net asset of Momi PLC was equal to the fair value, except for an item of property which had a fair value of 50 billion in excess of its carrying amount. So there is a fair value increment in PPE fair value increment. Do we all agree? Have you seen it?
Yes,
fair
sir.
value increment of 50, and then it has an additional depreciation of 5 also on the post acquisition. So let's go. So you have 50. PP. PP. So this will occur on when did they say it will occur?
Date
Is it
of
on the acquisition
acquisition.
date?
Yes, sir.
Okay. 50. So what will happen to the date of reporting?
We consider the depreciation, sir. Okay, 50. Nothing is there. 50 here.
Then you have depreciation. So what do we have? They give me balances now. What do we have?
Sir, don't we have other information regarding to the calculation of the net asset? Because I don't have the question.
Okay, let's go ahead and check. Additional information 1. I think we are done with that. Intangible assets, I think this one we use it under goodwill. Fair value we use under goodwill. Momi PLC goods or when we are doing group reserve.
Okay, that's all, sir.
I think that's all. You have a question? So what's the total of the net asset at the acquisition?
370.
370. Okay.
345.
345.
65. Okay,
65.
no, 80, no, 75, 75.
Okay. Workings 4.
Determination of goodwill.
Now, please, there's a mistake I made here. Let's quickly correct it. This fair value increase, since it was on acquisition date, it will mean that that fair value will also be recognized on the reporting date. You understand?
Yes, sir. 395. It will now be 395.
Which one? This one?
At the reporting date, yes.
395.
Because I wanted to raise hand concerning this.
So what do we have here?
Still remaining. Status quo remain the same.
This will be 25.
Oh, okay.
Yes.
That'll be 0. Okay, 25. That'll be 25.
It is now unbalanced.
Okay. 370 minus 345. Yes.
So we are good to go, right? Please always take note. Assuming that they said the fair value was on reporting date. That's when the acquisition, but since it was on acquisition date, it will also be reported on the consolidated date. You understand? Thank you. So let's determine the goodwill now. Purchase consideration. So now, purchase consideration. So we have to first of all determine purchase of consideration. Let's go and do that. Purchase determination of so this one can be workings 4B. Workings 4B. Determination of purchase consideration. So first of all, they sell Daddy PSE. Okay. I think Daddy PSE issue one for one, right? 1 for 2. Let's go, please. Let's go and check the question. You have the question, please be reading it out. I want us to finish this thing now. My battery is fully down. I don't have a light here. So please, Daddy, issue 1 share, ordinary share for 2 shares in equity. So we have 3 different purchase consideration here. I intentionally bring this question so that you will know how to calculate it in case you see it in the exam. So Daddy PSE are 1 for 2 share. 1 for 2 share. Now remember Daddy. What's this one? Determination of goodwill. Okay, purchase consideration. So you have share for share. Share for share. So Daddy acquire how many? 640 shares. That also
Million.
Yeah.
Yes,
So
sir.
640 multiplied by 1 for 2. So 1 divided by 2. What will it give to you? So you have share for share. 320. So he has 320. That means he acquired 320 billion share. But we're also told in that question that every of Daddy's, let's go back, that the market value of Daddy's PLC share, I think they mentioned that amount there. What is it? See it here. At the date of acquisition, the market price of Daddy PLC share was 75 kobo. So if Daddy acquires
320. No?
acquires 320 of here in mommy, it means that this 320 now will multiply by the market price. So the market price equals to
240.
Coming 0.75. Therefore, the cash, the share for share consideration equals to 320 multiplied by 0.75 kobo, which is equal to what?
240.
240 billion. 240 billion naira. Thank you. And then we're also told that let's go. Where is it? Number 2, they say issue 100 naira 12% loan note in database in exchange for every 400 share. Every 400 share. Please take note of that. For every 400 share. And remember, I remember that they acquired 640 shares.
640. Yes.
Yes.
640 divided by 100.
640 divided by 400.
Olafe, please mute your mic.
So that's we have, this is the one. The first one is share for share. The second one is also share for share, but the man borrow money to pay him. Share for share. So 640. That has 640 share in that place, but for the sake for every 400, so it will be 640 by 400, and the price is 100 naira. They say 100 naira. Remember, 100 naira. 100 naira of 100 naira 12% loan notes for every 400 shares. So multiply by 100 naira. That will be equal to what?
160 billion naira.
160 billion. So you have 1, then you have 2, then you have 3 now. 160 billion naira. 160 billion. And then the third one is cash consideration. I want to believe so, but I think I remember they said something like the man used 15 kobo or something. Number 3, they said a cash payment of 50 kobo per share for every share acquired in Mommy PSC. And remember, Mommy acquired how many? 640 billion share in Mommy's PLCs. And also 640 billion was what Mommy acquired. So all of these are still cash consideration for share, cash consideration on share. So that will be equals to 0. What is that? Is it 25 or 15? I can't remember.
15 kobo.
0.15. That's 0 naira 15 kobo multiplied by 640. What will it give to us?
96 billion.
96 billion naira. 96 billion naira. So therefore, total purchase consideration will now be equals to 320 plus 160 plus, what is it? 96. That's equals to what? For what?
570. Not 320.
Which one is 340 now? Okay, this one is 240. Sorry.
Yes, sir.
240. Oh yeah, equals to what?
496 billion naira.
496 billion naira.
Thank you so much. So let's go back to our purchase consideration for this goodwill. Remember, they said we use a full goodwill. That's 496B. Is that not so? Then I said the next thing you are going to add is add the value of NCI at acquisition date. The value of NCI at acquisition date. And then they will always give you this particular one in your question. They will always give it to you as long as they ask you to use a full or fair value goodwill method. So let's go and check. Additional information, I think it's 4, so 3. See it here. The group policies of value non-consolidated at full value. The fair value of the non-consolidated at the date of acquisition is 100. So you add 100. Add 100 to it. Add 100. So this is very, very, very seamless and simple. Just follow all that I am saying. I mean, and then you will deal with them in your exam more. So that's that for that. That's 100. And then you now less what is called
asset.
Net
asset.
Net asset of NCI or subsidiary at acquisition. That's why you have to do workings 3. So now, what I was explaining the other time, assuming we are going to use a proportionate here now, we are not going to consider this fair value of on net asset acquisition date. We are not going to consider it. We are only going to less the portion of the parent, from this net asset at NCI. What's the net asset now? Additional information 370. What is the net asset at acquisition date?
370.
I'm asking Oyindamola now. Oyindamola, what is the net asset as acquisition date?
370 billion, sir.
Okay, thank you. So now what I was trying to explain, assuming we are using proportionate now, what we will have recognized under this net asset will have a proportionate of parent net asset at acquisition date. Now we are not going to do 80%, right? 80% multiplied by 370. But because we are using full value method, full value, that's why we are carrying everything together under the net asset. Is that okay? I'm sure you understand. So, but we're also told that there is an impairment on goodwill, workings note 2. Under there's an error of television. They become illegal. NTA is to refund them 12 billion, but there will be a severe. There is it. As a result, the government board that DPSA of the that goodwill on constitution has been severely impaired by 30 billion. So that impairment, we remove it for us to get our current goodwill. Let's also impairment. How much? Impairment is what?
30 billion.
30 billion. So we are lessening this and this. Do you still have any lecture today?
No, sir.
Yes, sir. I have a question.
Please ask your question. My system may soon go off. That's why I'm asking. So I will go and power it, then I will reconvene again in the evening. We must finish today.
Yes, so
I don't understand the movement in asset. Net asset of the subsidiaries we did.
You said?
I don't understand how we did the net asset of subsidiary. How did you assume that the retained earning, that there was a mistake on the retained earning? That is
was
supposed
it not
to
meant?
receive 150 instead of 120.
Was it not me that give you this question? I did not assume it was a mistake.
Okay, but okay, sir.
It was a typo
That's one.
mistake.
Okay. But the solution we have, they use the same figure, and the depreciation too. I don't understand. What I have is different from what we are getting. I don't know. The depreciation in the additional information, they said yes, excess of its carrying amount with additional depreciation of 5 billion in the post-acquisition period to March 31st, 2020. And I don't know, we did not adjust that one, or should we leave it like that?
Okay, thank you for pointing this out. Well, when you have a current amount, I mean a fair value increase for a whole year, how are you going to now adjust depreciation for 3 months? That's the first question that should come to your mind. And remember, we are doing a consolidation at the end of one complete whole year. There is no way you will carry depreciation for 3 months. So where will the other 9 months go to? That's one.
It's 4 months they did per 1 quarter. That's what they did.
But
I don't know if that's correct.
It should be 3 months now. If it's 1st of January, it should be 3 months. 1st of January or the 1st of March is 3 months. How is it 4? Okay, you have seen this. You have seen this question in your Pathfinder.
Yeah.
Do you think Pathfinder can 100%? Pathfinders, they make mistakes very well. Don't rely on them. Please. If I'm going to give them a scale of 1 to 10, I'm going to give them 8. They are not 100%.
It's okay, sir.
Please go ahead.
As regards to the questions she's asking, as she said, they used 1/4. I think they actually used that 3 months. That's 3/12, making 1/4. I think that was what they did in the past question she's saying.
You reminded me now.
Okay. Now, you see, you can choose to do 1/4, or you can choose to do 1 year. But assumption is what matters. Assuming I'm the one that is using this 1 year now, I will have written an assumption here. Depreciation is carried for 1 year, as the fair value is expected to also run for a complete whole year. But if you're also using 1/4 to do it, I can bet you if you also use 1/4, we will still arrive at the same thing. Is that taken? Where this will majorly affect is the group reserve adjustments. Do you understand? Do you get it now? But for me, I feel it's better. We use 1 year. Do you understand? But for you people now want to get confused, we can use the 3 months that is in the question. But I'm feeling, in my own opinion, that's I'm entitled to my own opinion. In my own opinion, if the fair value was gotten on the date of acquisition, and we are consolidating after 1 year, depreciation should not and cannot be for 3 months, in my own opinion. But of course, your question says you should carry it for what is it called, for 3 months. So you can as well carry for 3 months. Thank you for that. So 5. Somebody want to ask question?
Hello, sir.
3/12. Go ahead.
Oh, sir, based on this, I think I will go with the initial solution that we did initially. Well, because according to the question now, the question said that that is as at 31st March 2020. Even if you want to come, and with the acquisition was 1st January 2020, it even shows that the depreciation of that 3 months fall in the year of the reporting year, which if you want to calculate, we're going to calculate 1 year.
Yes,
even that
that's why
3 months. Yeah, hey, even that 3 months falls in the year of reporting.
See,
so
you are entitled to your own opinion, Olafe, and what is our name too is also entitled to our own opinion. The only thing there is for you not to fail in exam, write down your assumption and give them the reasons for your assumption. They don't have the right to fail you wrong. It's your assumption, and that's why they said accounting principles are flexible; they are not rigid. Is that taken? Maureen, are you still raising your hand?
Hello, sir.
Go ahead.
But sir, if you want to go, though at the bottom line, we are still going to arrive at the same figure because we consider this depreciation part of to add to the additional depreciation we are going to have in the PPE. But meanwhile, the net assets now will be having in the net assets now, valuation of the net asset will be different, sir.
The valuation of the net asset may not be different. What will be different is the post-consolidation. The post-consolidation only affects the group structure because now the NCI will have to share from the post-consolidation as well as the parent. The parent will share, the subsidiary will also share. Whereas one like this 25 now, 80% of it will go to the group reserve, then 20% of the 25 will go to the NCI. Do you understand now? But that's the only place it will affect. So the materiality of anything that will happen at the end of the day will be minimal and should not make you to fail. That's why I don't want us to overstretch it. You are entitled to your own opinion, and she also entitled to her own opinion, and even Pathfinder, they are also entitled to their own opinion. But to me, I feel we should carry it a full year. But if they say no, 3 months, so please let's read follow them the way they have done it. But in case they repeat this question for you because they like to repeating questions. In case they repeat the questions, do 3/9 or 1/4 multiplied by 5. Is it clear? Sure, it's clear.
Yes. One last question, sir.
Go ahead.
Okay. I want to know why we did not include our intangible assets in our movement in subsidiary net assets.
Why would they not include it? We were specifically told to adjust for it under goodwill.
Okay.
Yes, we were told specifically to adjust for it under goodwill. You understand? Like now, since you have opened down this thing now, instead of waiting now, we will just go directly to your, what is it called? You know, this is your 650 plus 350 under PPE. Just quickly put minus depreciation 5. You put it there. You can close it because there is nothing that is coming there. That's workings what now? Workings 3. Then you come to this intangible asset minus 30. Abi? Workings 4. Is it workings 4? Yes. I think so. So let's go.
Sir.
Go ahead.
Sir. Okay. That PPE, the PPE on the net asset, that 50, are we not going to consider a part of the PPE here? The part of it we are going to add to the PPE on the as tangible assets.
We should add it.
Which 50 down?
Please, whoever had the full question should help us send it to the platform. Thank you. For us that don't have it, so that we can go through it.
May 2022.
Sorry.
The question is for May 2022 diet.
Sorry, can I say that the overly active? I'm not saying that people for you.
Our lecturer's battery, is it dead now?
I think it's there. They made mention that his battery is low.
Yes, I sent a message.
Adebayo, please, what question number, please? You said May 2022. What question number?
3. May
Question
2022. Question.
Okay.
Please, who have the Pathfinder assistant, please?
The Pathfinder is in the group. They've been posting it over and over.
I can't download it again. Sorry, help me to forward.
Okay, no problem.
Thank you.
Chiko Didi, please, can you read out the that additional information related to that 5 billion depreciation, please?
Hello.
Intangible assets was 5 billion. As at the date of acquisition, the carrying amount of the net asset of Money PLC was equal to the fair value, except for an item of property which had a fair value of 50 billion in excess of its carrying amount, with additional depreciation of 5 billion in the post-acquisition period to March 31st, 2020. This has not been reflected in Money PLC statement of financial position. Full stop.
Okay, thank you.
Hello, that we should meet past 7:30.
Hello, someone says, let me explain that part. That it is that overly part.
Everybody's understanding is different. The way you understand may not be the way I understand. And that's the reason for the small adjustments we are having. You get. But so that I will not go and explain and you understand something differently, and what he's doing may be a little bit different. But that's why in account sometimes we don't strive for the exact answer, because for one or two reasons you may not get the exact answer.
Sorry, if I can explain my understanding now, based on what you just said just now, I think the reason why we are considering the 3 months is because of we are not giving the lifespan of that asset, of that 50 billion. You know, after this, they know that we are going to get the depreciation going forward. I think that's why they consider just only that 3 months as the depreciation for the year, because we are not giving the lifespan of that particular asset that we need to consider as the fair value. I think that's the reason.
When you get to the exam hall now, for instance, you will not be assuming, like, all these things will not be coming into your head. What will be coming into your head is what you're seeing in the question. You understand? And you'll be solving based on that. You will not.
That's what I said that is my understanding based on what you just read. You know, I'm not with the question. You know, you do understand it now, but what you read now, that was what gave me that understanding that the reason why they calculated for that 3 months instead of 1 year is because of that, and because we are not even giving the lifespan of that particular asset. You know, I didn't mean that we are giving the lifespan of that particular asset now. Obviously, we are going to calculate for that 1 year because that 3 months falls in our reporting period. It falls in our reporting period. After calculating the 3 months, obviously, we are going to calculate for additional 9 months, which is going to give us. But in the absence of that,
Okay, hold on. You're already given the lifespan already. They say it's for 1 year, and that's the reason why he was doing for 1 year. But in the course of the additional info,
Is it
they
stated in
stated
the question that it's for 1 year?
The reason why he himself is doing 1 year now.
Oh, okay. Please, can you help me? Can you help me with that particular one? Before I check the agenda.
1 year, so you shouldn't extend that now. You understand?
Mr. Olafe, can I explain something to you?
Please go ahead.
Get the question. They said the depreciation is happened March, some that's 3 months. I know that a year is 12 months. You get so my assumption is that the depreciation is always the depreciation asset every 3 months. I know that if you divide 12 by 3 is 4. So you use 4 to multiply that 5 billion to get 20. So the 20, so the other 50 billion are going to.
Sorry, I'm really hearing what you are saying. Apart from the earpiece.
It's because everybody's nobody is unmuting yet.
Can you hear me now?
I think it's better now.
So now
okay, I actually wanted to, but they said no other thing is supposed to be sent outside next gen professional material. So I deleted it. If you're the person wanting the question, you can chat me privately. I will send it for you.
What did you say?
Can I explain now?
You can go ahead.
So now, in the question, it was said depreciation was charged on March something. So that means that now depreciation is not charged for just a particular period. It's supposed to be charged in a year, but the depreciation is always charged in that particular asset. Is always charged every 3 months. So if you divide 12 by 3, you get 4, which is your quarter. So is that 4 you are going to use to multiply that depreciation value, which is going to give you that 20 billion. You are going to deduct from the net asset. That's how they got the 20 billion. That is on. If you look at the solution, that's how they got the 20 billion, because the depreciation is for 3 months, and if you divide 3 by 12 in a year, you have that's like 4 times 3 months in 4 places. Do you understand?
You're making sense.
Yes,
Do you understand what I'm saying?
The question now is the date of application is January 2020. Are you getting it now? And whatever you want to consider, it has to be from as at the date of acquisition, which is January 2020. And this particular depreciation now falls within the period reporting year, which is, we acquired the particular asset on the 1st of January 2020. And this particular depreciation falls, even if after the acquisition, if you want to calculate depreciation, we are supposed to calculate the depreciation for the 1 year. Adding being that this question stated that the acquisition date was 1st April 2020, I will go with what you are saying that, okay, that depreciation was part of before the acquisition. So that is when we are going to factor it. But we are calculating for the 1 year. I'm not arguing because I still have to look at it very well so that to digest what they did. Thank you.
Okay, no problem. We are all correct. The thing is, just to remember that at the end of the period, just like he stated, you tell them that you assumed that depreciation was for 1 year. So just put that at the back of your mind. But if you are solving according to the question, there might be no need. You get. Please, I want to ask some of you that why are we not including the intangibles on our movement in net assets? Because I'm not seeing that.
The way we want to do the net asset, net asset is only involve the equity aspect only. The only
No,
condition that
movement to
when
net
we
asset
even
of
get
subsidiary,
this
not that.
PPE. Hello?
I can hear you.
Hello. So I said the
I
only
can hear
reason
you.
why we are going to factor in other items of the what was it called, balance sheet, it is when it requires additional information like this PPE. You know that PPE, this PPE in question now, because of this one is relating to the acquisition period. So that's why anything related to the acquisition period, that is what you are going to bring in into the net asset when we are considering the net asset of the subsidiary. I think you understand.
Okay.
Olafe, can I come in?
Yeah.
I think you need to go through the question very well. The 12 billion of that he was talking about is compensation received. If you read through that question,
No, hello. I'm not. My explanation does not relate to this question. Sure, you understand? I'm just saying on another. I didn't. I told you I'm not with the question. I have not read the question. I'm just following based on what we are reading and what you are saying. I didn't know that this question,
No,
what
it
she
does
asked,
now.
relating
That's
to this particular question. Okay, can you read it, please? Let's just deliberate over it.
The thing is because you don't have the question. Open the question.
Are you with me?
Open the question so that you get what you are
Send
saying.
it to
So
me
you not be
personally
answering
now.
off heart.
Send it to my WhatsApp, please. Send it to my WhatsApp, please.
He's calling me. Kí ló ń ṣe?
I said you should please send it to my
I
WhatsApp.
think you should send me a message so that I will know. Okay. Send me a message on WhatsApp so I will see your.
Okay, I'm sending it to you
I'm
now.
not
You
seeing
can
your
read it out.
message.
So okay, read it out now. So let's discuss it, please.
If I read it out now again, another point again. It's not everything you keep on your brain now.
Intangible. That's intangible.
Okay, the intangible. He said the intangible asset was a television program designed to promote the business activity of Mommy PLC. However, as a result of new government legislation on security matters on banditry and criminalities, such television programs have now been pronounced illegal in the country. The appropriate government security agency advised the company to immediately stop the television program, and 12 billion compensation is to be received from the television authority as a result of the new legislation. The government board of Daddy PLC was of the opinion that the goodwill on consolidation has been severely impaired by 30 billion.
But is that question relating to Mommy?
Yes.
Mommy and Daddy now. You see what I'm saying? If you have the question now,
He was specified now, Mommy PLC.
But wait, the question now is not relating to the date of acquisition. It's not related to proud. No, wait, Chikodi, please. Based on my own understanding, when we are trying to value the net assets, what we are filing is whatever we have, any information stated as the dates that we required. That is what is going to be on our date of acquisition. When we are doing the net asset valuation of the subsidiaries. Pardon?
See, when you're doing movement in net asset of subsidiary, you're doing for your equity, the equity of the subsidiary. Then you are doing your adjustment. Do you understand?
No, it's at the reporting date. That 12 billion is at the reporting date. It's at the reporting date.
Yeah, it's at the reporting date. If it is at the reporting date, it has nothing to do with the. If it is at the reporting date, it has nothing to do. It has nothing to do with this
the date
what's
of
it called,
acquisition.
with our net assets. It doesn't relate to the date of the, why we are doing this adjustment. We just want to know, as at the date of the acquisition, what actually did we acquire from the subsidiary. So that is what
Yes,
we
you
are
are correct.
considering.
You are correct. Is
So,
that the
but
reporting
let
date?
us have it at the back of our, it's not everything that we, you know, that's why I said it earlier, that why we have this PPE is because of this PPE relating to the date, the acquisition date. That's why we bring it in. I didn't be that is during the period, it will not have anything doing with the net asset of that subsidiary that we are considering, we are calculating. That's why they did not factor it into the net asset of the subsidiary. Anything that does not relate to the acquisition date, we are not going to factor it in. It is, and I mean, when we are calculating the net asset, though we still have to consider it when we are doing our adjustment in others. But in this
Okay,
net
but I
asset,
remember
this
one.
particular one has nothing to do.
Okay, okay. But I remember one thing he said when he was doing the introduction of this particular question. He said all these theoretical parts, all these story part has to do with the acquisition period. Then this write-up, this trial balance sheet, whatever, is your reporting or consolidation. Do you understand? So if you're saying does not have this particular this thing I read now does not have anything to do with the acquisition, I please, I don't understand, or are you misinterpreting the two or something? I don't get. Because me,
Yeah,
right from
excuse
time,
me.
I've known that
Hello.
the movement to next asset has to do with adjustment. When you pick your
Yes.
ordinary shares, then you adjust for fair value, adjust for depreciation if there is any. And you know, adjustment for depreciation is always stated in the date of acquisition. It's always in the additional info. So how then do you adjust for depreciation when it is not stated in the date of consolidation? Do you get it?
Sorry, I don't. Are you talking about this depreciation that we carry into this net asset?
What
I'm
is that?
talking
Which
about
one?
the contingent
I don't.
asset.
The intangible assets. No, that is what she's
That's what I'm
talking
saying. Now,
about.
see, that intangible, not that we are not going to, because you know that anything in the additional information requires adjustment. Not that we are not going to
Yes.
adjust for it. So I
Yes.
think we are going to adjust
No,
for it.
Yes.
But what I'm saying now is
you
Okay,
that
talked
wait.
about
What I'm
that
it.
saying.
adjustment,
Hello.
hello, what I'm saying now is the adjustment will
Hmm.
not affect that adjustment we are going to do, not on this net asset. We are still going
I
to adjust for
understand.
it.
I understand that one. I'm talking about the contingent assets that I just read for you now. There's an additional info on that, which also will be adjusted in the movement of this net asset. That's the one I'm talking about. Do you get it?
Yes, sorry. It will be adjusted in the net asset, but not under the date of acquisition. It should be under the reporting date. It's under the reporting date, but under the what you call the net asset of the subsidiary, but it should be at the reporting date.
Hello.
Under the solution they give, is there, is treated there.
Yes. Hello. See, hello. On
I can
that
hear
issue
you.
of that,
I can hear you.
the issue of that intangible asset. So if you check the different statements of financial position of daddy and mommy, you see that under mommy, they have already reported 40,000 as their intangible assets. They have reported it.
Yes.
But when you now
Yes.
come to this additional information
Yes.
now was telling us that intangible asset is a television program. You understand? And they are saying that television program is not going to be in existence again. So in that they should have 12 billion for compensation. That means they are not going to report that 40,000 as intangible asset again. You understand? What they will be reporting is the 12 billion they are getting for compensation. That is why if you check in their statement, they have to remove that 40 million intangible assets from the assets. Now add the 12 million compensation they will receive. Because that program has been cancelled.
Yes, but why did we not do it like that in our own? That's what I'm asking. Why didn't we do it like that?
Let him come back now. Maybe he didn't take note of it. Maybe before he comes back now, he has to read it very well and understand.
Yeah.
Even this themselves, their own problem is too much. The Pathfinder, because when you check now, the retained earning now, you see the retained earning now from the statement of financial position that was given. They said retained earning at January was 120. Then the one at December was 50. So, but when you come to their workings now, you see that they recorded 170 and 150. So where did they get it from? Did you check
let me explain that one.
Okay.
They did
All right.
What they did there, and I think during my my first diet, yes, one of the lecturers also said something like that. He said they added up the retained earning at the beginning and added the retained earning at close because it's just 1 year.
Okay, to be the reporting date.
You understand? Yes. And it gave them 170.
To be the reporting date. Yes.
And they used,
thank you.
And they used the 120, which is the retained earning at the reporting period as 120. That's what gave them that 50. They used.
Okay.
Do you get it?
Yes.
But now
I got it now. Thank you.
That's what I understand though. But the one we are solving is a little different. You get.
And
but
when you look at
like him now, he just
you know.
He said there's a mistake there. But if you now think that you don't know, you're not a professional, you wouldn't know if there's a mistake or not. How will you even know if you did not solve it? And under exam conditions, you cannot start saying that there's a mistake for where you just assume everything is correct and perfect.
Yes. Okay.
Like that one now.
Because when you
like that
look
one
at it, yes. But when you look at it, they say at the beginning is 120. Then at the ending is 50. That 50 is just for 1 year. So when you add the 1 year plus the one you add at the beginning, you now have the full retained earning of 170.
For the year, yes.
Good. Help also.
And see another thing, you know, when you're doing for balance sheet, statement of financial position, but when you're doing some of your adjustments and they say goodwill, depreciation is for 6 months, you know, you're going to multiply that figure they gave you by 6 all over 12 or the number of years involved. That's exactly what I think they are doing in this March. So do you get it? So it don't just like you want to solve. But he himself, I understand his point too. He did it. He already knows it. You know, he's a professional,
So
grounded
now, this
in
depreciation now.
But me and you now.
Okay, let's assume now. No. It's only see now. This depreciation now that they said depreciation in post-acquisition periods to March 31st, 2020 is 5 billion. Then to get for that year, so what is it going to be? That means every March, every first quarter, or every quarter is 5 billion. Every quarter is 5 billion. It's 5 billion.
Okay, normally it's supposed to
then
be
for the 4th quarter.
It's supposed to be every quarter. Do you understand? But he himself is correct
because they have
because of the explanation he gave.
Yes.
Yes, that's why
That
they
is
have that
every quarter.
50,000. You get it? But
The 5,000 is for a quarter.
it's
So
20,000
now
every
get
quarter,
to the end
20,000.
of the year.
Yes.
These
I
people,
thought
all
you
these
get
things are tricks just to confuse you or to really test you to know if you really know what you're doing. These are the tricks.
And we don't have all the time. Don't have all the time yet to start thinking how will I do it and how will I not do it. Because moving ahead. This financial reporting, it has you think it's easy, simple, but the wahala is this adjustment and non-adjustment because they will put one
all
in
these adjustment and adjustment, yes.
Shikodi, please, I just sent a mail now. I just sent a message to the group now. I was the one that sent a message to ask you to send in past question to me in the group.
No.
Thank you.
You didn't get what I said. I said they don't allow sending materials that is not next gen in the group. Do you get? That's why I say you should private.
You send it to my WhatsApp. Pass on now. So that, I can't find your number. So that's why I said so that you can copy that message from the group to send it to me personally. Thank you.
Yes, sir. All right, sir.